All right, welcome back to the deep dive. We're all about getting to the heart of things here, cutting through the noise and figuring out what really matters. And let's be real, you're listening because you want to understand the big forces shaping our world, right? You want to be in the know, but you don't have time to wade through all that jargon.
That's it, exactly. No one wants to feel lost or overwhelmed, right?
Exactly. So today we're diving into something super fundamental, something that impacts pretty much every aspect of our lives. We're talking about economic conditions, and we've got a ton of material here, reports, articles, all sorts of stuff, all about what drives our economies and how that impacts businesses and
The
consumers,
whole shebang.
the whole shebang.
Yeah.
So our mission today, if you will, is to really give you a clear, insightful, and even actionable understanding of these key economic factors. And of course, their effects, because that's what matters, right?
Yeah.
How does this stuff actually play out in the real world?
Exactly. I mean, we're not just going to run through a bunch of definitions and dry theory, right?
Right.
We're going to show you the real world impact, the so what behind all these economic shifts, and connect the dots in a way that makes sense for you, in a way that you can actually use.
Perfect. So to kick things off, let's start with the basics. What exactly are we talking about when we say economic conditions?
Okay, great question. It's more than just a general feeling, right? Like, oh, the economy's good or the economy's bad.
Right.
It's really a bunch of key elements all kind of interacting with each other, influencing each other constantly. So you've got things like interest rates. So think about that as the cost of borrowing money.
Okay.
You've got wages, the level of employment and unemployment, right? How many people are working, how many people are looking for work, exchange rates between currencies, and then, of course, the big one everyone's talking about these days, inflation.
Hmm.
And the fascinating thing is how these factors influence not just businesses, how competitive they can be, but also you, right? You as a consumer, like how much you can actually spend, how much you're willing to spend. It's a dynamic interplay.
It really is. And it's constantly changing, right? I mean, it's not static. The economy seems to go through, like, its own ups and downs, these cycles.
Absolutely. And the material we're looking at actually refers to this as the business cycle.
Yeah.
And it kind of outlines these four key phases. You've got expansion. A lot of people call that the boom period.
Okay.
Then you've got the peak, and then a contraction, which is the bust.
Right.
And then finally the trough. It's this recurring pattern of growth and slowdown that economies tend to go through.
It's like a roller coaster.
Okay.
So let's break down these phases a bit more. When you talk about that peak period, what does that actually look like? What's happening in the economy when it's at its peak?
Yeah. So at the peak, you're typically seeing really high levels of economic activity. Businesses are humming, wages and salaries are generally pretty good. Businesses are running at or near, full capacity.
Right.
They're producing as much as they can, selling as much as they can. Sales and profits are strong.
Yeah.
And employment is high, which obviously means unemployment is low.
Yeah.
It's a time of, widespread prosperity.
It sounds good, but obviously things don't stay there forever, right?
Yeah.
What starts to happen when things shift into that contraction phase?
Yeah.
What are some of the warning signs?
Yeah, so during contraction, that optimism, that kind of buzz that you have at the peak, it starts to fade. Consumer spending, people start to get a little bit more cautious. They pull back a little bit. And businesses sense this, right? They see the slowdown happening. And often they start to get a little bit more pessimistic, a little more cautious themselves, and they might start to reduce their investments. So instead of, maybe expanding or hiring new people, they might kind of hold back, see how things play out. And this leads to, falling sales, profits start to dip. And unfortunately, that often means businesses have to let some people go. So you see a decrease in employment and unemployment starts to creep up.
Right. So that slowdown eventually leads to the lowest point of the cycle, right? The trough. What does that look like?
Yeah, the trough is basically, the opposite of the peak. Economic activity is at its lowest point.
Yeah.
Wages and salaries are generally pretty low. Businesses are operating way below their potential. They've got capacity to do more, but the demand just isn't there.
Yeah.
Sales and profits are down. Consumer spending is, really low. And unfortunately, unemployment is high. So it's a tough time,
Yeah, it sounds like it. But the good news is, after the trough, things start to recover again.
Hopefully, yeah.
Yeah, hopefully. And that leads us into the next expansion. So what are some of the things that start to happen when the economy is on that upswing?
Yeah. So in an expansion, you start to see a real turnaround. Consumer spending begins to pick up. People feel a little bit more confident. Maybe they've got a little more money in their pockets. And businesses start to feel that too. They become more optimistic. They start investing again, taking some risks,
Mm.
sales and profits improve. And really importantly, employment starts to increase. So businesses start hiring more workers, which of course brings down the unemployment rate. So it's the growth phase where the economy is really starting to regain momentum.
Okay. And you know what? The sources we have actually describe this really well visually. Like if you imagine a line graph, with those clear peaks and dips, it really helps you visualize that cyclical nature of the economy. It's up, it's down, it's up, it's down. So we've talked about these upswings and downswings. How does this actually translate to real world impacts for people,
Yeah.
for businesses and, for us as individuals?
Yeah, so during a downturn, the impact is pretty direct. I mean, reduced spending, less money flowing around means fewer customers for businesses,
Right.
less revenue, less money coming in, and in some cases, it can actually lead to closures. We'll look at a specific example of that later on. But on the flip side, during a boom, more people are employed, they're earning more, and there's just a greater level of spending overall.
Yeah.
That creates all sorts of opportunities for businesses, opportunities to grow, to innovate, come up with new products and services, and potentially, bring more people on board, hire more people.
So it sounds like businesses really need to be on top of these shifts. Like, how do they actually get a sense of where the economy is headed? Is it like, reading tea leaves or something? Or are there more concrete ways to anticipate these changes?
Yeah, I wish it were as simple as tea leaves,
Right.
would make things a little more interesting. But no, there are these things called economic indicators, and that's what businesses really rely on. It's basically key pieces of data that kind of give you a snapshot of the health of the economy. So things like the rate of economic growth itself, right? How much is the economy actually growing? Inflation trends, is it going up? Is it coming down? Is it stable? How much are people earning on average each week? That's a good indicator. Consumer confidence, how are people feeling? Are they optimistic? Are they pessimistic? Interest rates, always a big one. Overall consumer spending, how much are people actually spending? And then, of course, the unemployment rate. These are all the vital signs of the economy.
So it's about tracking those indicators to try to predict what might be coming next.
Yeah, exactly. By monitoring these indicators, businesses can kind of anticipate potential challenges or opportunities. So, for instance, if consumer confidence is declining, people aren't feeling too good about the economy, businesses can prepare for that.
Hmm.
Maybe they adjust their inventory, don't order as much stock, or they adjust their marketing, try to appeal to people who are maybe a little bit more price sensitive. But if interest rates are low and consumer spending is up, that's usually a good sign. It might be a good time for businesses to consider, expanding, taking advantage of that positive momentum.
So it's about informed decision making.
Absolutely.
Okay. And just to really drive home how impactful these economic conditions can be, the sources we've got actually include this pretty stark example. They mentioned that in Australia, just between 2021 and 2022, nearly 4,000 companies went bankrupt.
Wow.
And a huge contributing factor, the sources say, was that poor economic climate at the time. Things like falling consumer confidence, interest rates were going up, and those cost of living pressures that we're all feeling. It's a real reminder that this isn't just some theoretical discussion,
No, it's not theoretical at all. These economic forces have a real impact. And sometimes, yeah, severe consequences, unfortunately, for businesses, for the people they employ.
It's real people's lives. Absolutely. Okay, so we've talked about this overall picture of economic conditions and the business cycle. Let's zoom in now on some of those specific economic influences that we mentioned earlier. Let's start with interest rates. What are they exactly, and why are they such a big deal?
Okay. So, in simple terms, an interest rate is the cost of borrowing money. So it's the price that lenders, like banks, charge for the use of their funds.
Mm-hmm.
And it's typically expressed as, an annual percentage. So for businesses, if they need a loan to buy new equipment or expand their operations, they're going to have to pay interest on that loan. And that interest is a direct cost.
Makes sense.
Now, what's interesting is that interest rates tend to go up when there's higher inflation, which, we've definitely been seeing,
Yeah.
or when there's really strong demand for credit in the economy.
Okay. And what happens to businesses when interest rates go up? How does it affect them practically?
Well, when borrowing becomes more expensive,
Mm.
right, businesses might think twice about taking out those loans. Maybe they were thinking about expanding, investing in new equipment. But if it's going to cost them a lot more in interest, they might say, you know what, let's wait and see how things go.
Right.
And even existing loans that they already have become more costly to service, to make those repayments. So it really eats into their profit margins. It can really stifle business activity because the cost of doing business, the cost of funding those new projects, it just goes up.
Right. And of course, it's not just businesses, right? It's consumers too. We feel the pinch when interest rates rise.
Absolutely. Higher interest rates mean we're all paying more for our mortgages, car loans, credit card debt, and that leaves us with less money to spend on other things.
Less disposable income.
Exactly. And as we've talked about, less spending then has a knock-on effect on businesses. It's all connected.
It's a cycle. Okay,
Exactly.
so what about the opposite? What happens when interest rates go down? I imagine that's a good thing, right?
It can be, yeah. Lower interest rates definitely make borrowing more affordable. And for businesses, that can be a real incentive. Maybe they'll be more likely to take out those loans, invest in their growth, buy that new equipment, or develop that new product line.
Right.
And for consumers, lower rates, it means more money in our pockets after we've paid off our debts, which, we can then spend on other things, goods and services, which then boosts sales for businesses. And it can potentially lead to, a virtuous cycle of growth.
Okay, that makes sense. Now, another big piece of the economic puzzle is employment levels. And our sources actually go into some pretty specific definitions about who is considered employed and unemployed. Can you walk us through that?
Yeah, sure. So in Australia, for example, you're considered employed if you've worked for at least 1 hour during a specific week.
About an hour.
Yeah. And unemployed, on the other hand, means you haven't worked for at least 1 hour in that week, you're actively looking for work, and you're available to start a job.
So you have to be really actively looking for work to count as unemployed.
Exactly.
Interesting. And these employment levels, they go up and down with the business cycle too, right? Like interest rates?
Absolutely. So during an expansion, businesses are growing, they need more staff, so employment typically increases, and that unemployment rate drops. But during a contraction, businesses might have to, downsize, lay off workers, and that means employment decreases and unemployment goes up.
Makes sense.
Yeah.
How does this affect how businesses plan for the future, though? Like, it's got to be more than just filling those immediate vacancies, right?
Yeah, for sure. During periods of really strong economic expansion, businesses can actually face some real challenges finding enough qualified workers.
Oh, interesting.
Yeah, it can lead to labor shortages. And that forces them to increase wages to attract and retain staff, right?
Right.
They have to be competitive. They might even need to consider, looking for employees overseas, which can be a whole other process. And these hiring difficulties can actually slow down their growth plans.
Yeah.
Like, they might want to expand, but if they can't find the people to do the work, they might have to put things on hold.
Okay. That's something I hadn't really thought about. Let's move on to another area that directly affects both businesses and individuals. Tax rates.
Yeah.
How do taxes fit into this whole economic picture?
Right. Well, taxes are basically a cost for businesses. They're unavoidable, right? And a tax rate is simply the percentage of income or the value of an asset or a transaction that's paid to the government as tax. And we all know about personal income tax, right?
Yeah.
But businesses have to deal with other taxes as well, things like company tax, which is a percentage of their profits, or land tax on property that they own.
Okay, and so these tax rates, can they actually influence the decisions that businesses make?
Oh, absolutely. I mean, if the government's offering tax incentives or deductions for specific activities like investing in new technologies or, hiring apprentices,
Right.
that can make those activities much more attractive to businesses. So it's a way for governments to kind of steer economic behavior a bit,
Yeah.
encourage certain types of activities that they think will benefit the economy as a whole.
Okay, interesting. The sources also mention different types of tax systems, like progressive, proportional, and regressive.
Yeah.
Can you give us a quick explanation of what those are?
Sure. So a progressive tax system, like income tax in a lot of countries, means that the more you earn, the higher the percentage of your income you pay in taxes.
Okay.
It's kind of a sliding scale. Then you've got a proportional tax system, like the company tax we mentioned, where everyone pays the same tax rate, regardless of their income or the value of their asset. And then a regressive tax system is one where lower income earners actually end up paying a larger proportion of their income in taxes compared to higher earners.
Even if the rate is the same.
Yeah, even if the rate is the same. Because, certain taxes can hit lower earners harder.
Right.
It's a bigger chunk of their income.
Okay. So the last specific economic influence our sources talk about is business and consumer confidence levels. And this seems a bit more about, feelings, sentiment,
Right.
rather than hard numbers.
Yeah, you're right. It's about how businesses and individuals feel about the economy, both the current state and, what they think might happen in the future. But those feelings, they actually have real-world consequences.
Interesting. So tell me more about that.
Hmm.
What happens when consumers are feeling confident?
Well, when consumers are confident, they generally feel good about their jobs.
Mm-hmm.
They feel secure in their financial situation, so they're more likely to spend money, right?
Makes sense.
They're not so worried about the future. They're happy to go out and buy things, travel, and that increased demand really fuels economic activity.
Right. And what about businesses? How does that positive outlook, both from businesses and consumers, how does that impact the decisions they make, their plans for the future?
Yeah, so when business owners are optimistic, they're looking ahead, and they see that consumers are spending, they're much more inclined to invest in their businesses. They're like, okay, this is a good time to grow.
Right.
So they might expand their operations. Maybe they'll take on some debt to fund that growth, and they'll start hiring more employees to meet that anticipated demand, right?
Yeah.
So high confidence levels can really drive economic expansion. It's almost like this positive feedback loop.
Yeah, like a self-fulfilling prophecy almost.
Yeah, optimism encourages spending and investment, which then reinforces that optimism.
Right. So we've talked a lot about these different forces at play, but what about the role of the government? I mean, do they just sit back and watch this all happen, or do they try to manage it somehow?
Oh, no, they're definitely not just sitting back. Governments actually use a whole range of tools, and they're primarily known as monetary and fiscal policies to try to moderate the swings of the business cycle. So they're trying to smooth out those peaks and troughs a little bit.
So basically trying to keep the economy on a more even keel.
Exactly. Now, monetary policy, that's often managed by a central bank, like the Reserve Bank here in Australia.
Yeah.
And that involves influencing interest rates and the availability of credit.
Okay.
And then fiscal policy, that's all about the government's decisions about spending and taxation.
Right. So the government is kind of pulling these different levers, trying to influence things.
That's right. And the goal is to try to cushion the impact of recessions. So when things are slowing down, they're trying to soften the blow.
Yeah.
And then on the flip side, when things are booming, they want to prevent the economy from overheating, because that can lead to problems too, like really high inflation.
Right. So they're trying to find that balance.
Exactly.
Now, our sources actually do a good job of summarizing what those recessionary and boom cycles typically look like, kind of like a checklist of characteristics.
Right, yeah. So in a typical recession, you'll generally see rising unemployment. Economic growth slows down, it might even go negative, and often inflation starts to stabilize, it might even fall. And you see businesses cutting costs, maybe through layoffs or, just holding back on investments. And consumers become more cautious. They start saving more, spending less. And that lower confidence, that has a direct impact on business profits. So it's this kind of downward spiral.
Right. It's all interconnected. And then, of course, a boom cycle is kind of the opposite of all that.
Yeah, pretty much. During a boom, unemployment's falling, economic growth is accelerating, and you often see inflation going up, which can be a concern. Businesses are ramping up production, they need more workers, they're expanding.
They're hiring.
Hiring, yeah. Consumer confidence is high, everyone's feeling good, spending money, business profits are rising, it's a good time.
Sounds like it. Okay, so we've covered a lot of ground here. I feel like I have a much better understanding of all these different pieces. But for someone who's just starting to wrap their head around this, what are the key takeaways, the big things they need to remember?
Well, I think the most important thing is understanding that economic conditions really matter. They're not just some abstract concepts. They have a direct and real impact on our lives, on businesses, on our jobs, on our finances.
Mm-hmm.
So things like interest rates, employment levels, tax rates, consumer confidence, these aren't just things you read about in the news. They're actually forces that shape the opportunities and the challenges that we face. So by paying attention to these forces, you can be better prepared, you can make better decisions for yourself, for your business, for your future.
Absolutely. I feel like this deep dive has really given me a framework for understanding the economic news I hear every day.
Yeah.
And also the decisions that businesses around me are making. Like, now I kind of get why they might be doing certain things.
Yeah. Exactly. And it kind of leaves us with this interesting question for you, the listener. Considering all these economic cycles, these influences, what are some maybe less obvious ways that these shifts might impact you?
Well, I like that.
Not just in terms of your job security or, how much you can spend at the grocery store, but think about the ripple effects. Like, how might changes in interest rates affect the housing market in your area? How might shifts in business confidence influence the availability of new products or services that you might want to buy? It's this really complex system, right? And understanding these underlying economic forces can help you see those connections in new and insightful ways. So keep that in mind as you go about your day-to-day life. Look for those connections.
That's a great point to end on. Thanks for joining us today on the Deep Dive.
Thanks for having me.